appreciate you joining us again for another webinar on transfer pricing, everybody's favorite topic. I know it's certainly mine. So again, my name is Jason Fritz. I'm a senior manager here at Eide Bailey in our national tax office, and I focus pretty much entirely on transfer pricing, although with our US tax reform, international tax has become a large part of my purview as well, which we're certainly going to talk about a bit today. We have our disclaimer here, which I'm not going to pause on too long, but we'll get to our agenda, and we're going to talk a lot about the international provisions related to US tax reform, because that really does affect our transfer pricing planning, and especially obviously transfer pricing planning and how it affects a company's effective tax rate going forward. So we'll spend some time talking about those technical aspects, and then we'll cover transfer pricing planning. And really, we need to talk about what we used to talk about, or what we used to plan into the structures to talk about where we are today. There's some changes, a lot of changes due to the international tax provisions of US tax reform. So again, we'll start talking about what we used to do in terms of the planning situation, and talk about now kind of the things that we need to think about, or some of the things that companies need to think about when we're thinking about transfer pricing and effective tax rate planning. Before we actually change slides here though, what's not in this presentation, what I frequently include in presentations about transfer pricing, just as kind of a basic primer on transfer pricing. So in other words, what the heck is transfer pricing? So I'll talk about that. We don't have slides on that, but I will just talk about that briefly now, just to kind of refresh everybody's memory. So what are we talking about here when we're talking about transfer pricing? So transfer pricing is the price at which your tangible property, your intangible property, your services, and your financing, the prices that you're paying on those transactions between two related entities. So it all comes down to related party transactions. So you have two entities that are part of the same group, whether it's a parent and a subsidiary, or brother, sister, some relationship between entities, and the pricing of the transactions. And again, the types of transactions are fourfold. I think everybody's aware, frequently thinks about tangible goods. So you're selling of things, widgets, whatnot, back and forth to and from related parties. But don't forget about intangible property, first of all. So the use of trademarks and trade names, know-how, business processes, whatnot, other more nebulous things that really should be compensated for use from one party to the other. I think most frequently what we see now are service transactions, so services provided by one entity for another entity, and that one I think, again, we see most often, and people don't tend to miss, but don't forget about those services transactions. And the fourth and final one, intercompany financing, and this one gets missed all the time. So if you have entities that are related and lending to each other, don't forget that there needs to be some interest rate component. So that is a transfer pricing aspect, and there's a section of the 482 regulations, not to bore you with regulations speak today, but there's a section directly related to intercompany financing. So you do need to take that into account when it comes to transfer pricing. And finally, before I switch slides and begin on the international provisions, don't forget about the arm's length standard. So transfer pricing has to do with, or requires, arm's length pricing. In other words, what would a third party have earned, or what would a third party be paying you if you were not related? So the prices intercompany or related should be that what you would pay or be paid by a third party. So those prices need to be arm's length. And really, I had a client conversation last week. I have to explain transfer pricing to folks, and after I did, this client summarized it quite succinctly, and I thought very well, in that transfer pricing matters, and why we have transfer pricing is so companies don't, and this is verbatim, don't monkey with the intercompany pricing so that they pay less taxes than they should be paying. And that's right, because we have different tax rates in different countries, in different states, in the United States as well, but we have different tax rules, and we have transfer pricing laws and regulations and guidance, so that companies don't actually put taxable income into a lower tax jurisdiction just for the benefit of the lower tax. So that's it in a nutshell. So I just wanted to mention that. Again, it's not on these slides, but just to level set, and I often like to include that just to kind of talk about where we're at. So, largest tax act in 30 plus years, which I'm sure everybody is well aware of, but when it comes to the international provisions and transfer pricing, really the biggest thing that we saw is obviously the reduction in the corporate tax rate from 35% to 21%. Obviously, the individual stuff and flow-throughs are different there at the individual rates, but that is a massive, obviously, cut in the tax rate and has brought the United States to a similar level to a lot of other countries around the world. There were individual changes which we're not going to cover today, but a ton of business changes for partnerships and S corps and corporations. And we are still waiting for guidance on this. It's actually been coming faster, much faster than anybody expected. Regulations historically have taken years to come out, and the Treasury has done an excellent job, I would say. My opinion of getting regulations actually out the door for these changes that Congress came up with, coming up on, well, it'll be 2 years this December. So this is kind of this is another discussion of this. So again, we have the corporate tax reduction. So we'll cover each of these, but just to list them off, we have global intangible low tax income, or GILTI, which I'll use the anomaly. It's the stick, or the disincentive, or was intended to be the disincentive, I should say, to companies shifting intangible income or any income really overseas. Then we have foreign derived intangible income, which some people call FDII, others call it FDII. So we have some really good acronyms here in the international aspect of tax reform. So we have FDII, which is the carrot to the stick. So this is the incentive for companies to do more functions, especially more intangible based functions, higher, more non-routine things in the United States, and to sell stuff out of the United States at a reduced rate. So trying to increase that base and reduce the rate. The next item is base erosion and anti-abuse tax, which is BEAT. So again, another great acronym. And that's really an alternative minimum tax, and that's again more of a stick, or that's more of a disincentive to shifting stuff outshore, or actually making payments to related parties that are offshore. So really the essence of the international aspects of tax reform was to apply a lower rate to a broader base of taxable items. So here we come to polling question number 1, which Ali will pull up. So what is the major reduction percentage in corporate tax rate? This is the reduction 2. So I'll give you a clue. We were at 35%. We dropped to a different rate. Which one of the 4 here is it? Is it 21%, 20%, 25%, or 50%? And we'll give you a second to enter that in. And yeah, again, that's for the corporate rate. Individual rates, which we see, obviously dropped as well, but that 21% does qualify for the corporate rate. So we do have the correct answer is 21%. So 20 was in there. I see a few people selected that one. It's close. It's a little tricky there. Apologies for that, but again, 21% rate, and really just kind of an anecdote on that. There has been talk about that rate potentially going up in the future. So it's something also when you're thinking of doing some planning to keep in mind. I have nothing to back that up other than just talk out of Congress, and obviously elections matter, and so there could be changes in the future, especially as there's an increased discussion around budget deficits and whatnot, and revenue coming into the U.S. coffers. So just keep that in mind, or just a little anecdote on the corporate tax rate. Okay, let's talk about GILTI. So it's essentially, as I like to summarize it, it's a new type of Subpart F income. And Subpart F, for those who aren't familiar, it was really the anti-deferral rules that are still in existence and were previously, prior to US tax reform, really the only anti-deferral rules that we had. But it applies to individuals and other US shareholders, and there's some special deductions for C corporations, which really like to emphasize that. A lot of these rules have special incentives or have less impact for C corporations, so that's something to consider also when doing planning. So it's similar to Subpart F. The effect really is to tax at the US rate anything that was below the US tax rate in a foreign subsidiary. So I'm really kind of summarizing that. So if you think about it, the point is like, hey, if you're shifting things or you're doing things in a lower tax jurisdiction, the US wants a piece of that. So we're going to try to grab that and bring it to at least the corporate tax rate at 21%. Now, again, going back to the C corps, they have a 50% deduction of GILTI up until 2024, and again, that's a ways off, and who knows what will change in that time. But it really kind of minimizes the effects for C corps of GILTI. So there wasn't a whole lot of change for C corps unless we're talking about a tax jurisdiction where there's an extremely low corporate rate. So just be mindful that, and I'm kind of getting my head of myself here, but when we traditionally have planned for international tax to reduce taxes or to be tax efficient, we were looking for lower tax jurisdictions. Well, that may not be the case now, which we'll talk about a little bit later. So we need to consider GILTI when doing that planning. So just be aware, the foreign tax credit situations have changed as well. You don't get 100% foreign tax credit anymore, so you need to actually plan around that as well. So just be aware. Oh, and we're at polling question number 2. Allie, do you want to pull that one up for us, please? So the question is, the U.S. shareholder shall include in gross income its GILTI in a manner similar to Subpart F income. So it's more clues for you on this one, as I did talk about Subpart F income quite a bit in the last few minutes. So I'll give you a second to plug in your true or false answer to this question. All right, what are the results here? Yes, the vast majority selected the correct answer, which is true. You have to include in gross income your GILTI so that you're taxing at the U.S. corporate rate at 21%, or at the individual rate if you're a pass-through. Let's not forget about those partnerships. So next, we are covering, oops, skipped ahead a few slides here. Let's not skip over FDII, FDII, whatever you want to call it. It's a new section 250. It, again, is the incentive for companies to, well, produce things in the United States. The idea being the intangible property exists in the United States to actually manufacture or produce stuff. So that's thus the mention of intangible in the name. What it does, and again, really first and foremost, you should be aware that this incentive is for C corps only. So again, that C corporation gets this incentive or gets a benefit, whereas your partnerships, your S corps do not. So what you get is a reduced effective tax rate for goods that are produced in the United States that are utilized in a foreign market. That tax rate is, as you can see, 13.8% on those goods that you sell. Services do qualify as well. It's a little more complicated, or actually it's a lot more complicated to get services to qualify for your FDII benefit. But essentially, if you're producing something in the United States or having it produced, you sell it to a foreign market and it's used in that market, then all that income, so the gross receipts minus total costs, taking into account any GILTI, which let's not get too complicated here, but take into account total costs, that income can be taxed at 13.8%. Now, it looks like a good benefit, and it really is. Compared to 21%, that's a pretty big chunk. But you have to consider that you're allocating some costs to that income that would normally be deducted at a 21% rate. So it's not a pure 13 1/8%. So it's not a pure, 7 7/8 benefit, but it's close. It's obviously a worthwhile exercise to do. The interesting thing here is that it's also for related party sales. So when it comes to transfer pricing, let's say you're selling it to a foreign subsidiary, and that subsidiary just sells that to that local market, then that does qualify for the FDII benefit as well. So it is a pretty big thing we need to consider when we're doing some planning, which we'll talk about here in a minute. But again, to repeat myself, only C corporations are eligible for FDII benefit. So we'll talk about BEAT briefly here. Again, it really is an alternative minimum tax, and you have to take a ratio. The calculation is pretty complicated, but and let me take a step back. I apologize. So it only qualifies, or it only applies, I should say, to C corps that have annual gross receipts of at least 500 million. And really, if you read into the BEAT regs, it's domestic. So that 500 million gross receipts is for domestic sales. So that in itself can bump a lot of companies out of BEAT. You don't have to worry about it as much. So, but if you are a C corp, you do have annual gross receipts that are at least 500 million for a 3-year prior period, then you need to be aware if you have intercompany payments leaving the U.S., you need to take that percentage of payments to total taxable income, and if it reaches a certain threshold, then you may have to pay an alternative minimum tax in addition to your normal taxable income. So yes, it's quite penal. I haven't seen it a lot, honestly, for Eide clients. One example that we did see it is we did have one of our larger clients, so clearly 500 million in domestic revenue, was purchased by a foreign company, and that foreign company loaded it up with debt, so it had an intercompany debt payment, including interest, and some additional other services payments going offshore all of a sudden. Well, it triggered the BEAT. They realized that the way they set it up, especially due to the debt payments, they were going to have to pay an additional minimum tax on the transfer pricing, or because of the transfer pricing, the way it was set up. So just to be aware, you may actually qualify or actually be required to pay an additional payment. Which brings us to polling question number 3. What is the tax rate? I assume this is actually FDII rate for 2025. And so Ali, will you please pull up polling question number 3? So what is the FDII tax rate for 2025? This is not the corporate rate, which is 21%. So just be aware, this is FDII was at 13 1/8%. It's going to go up starting in 2025 to a certain amount. So my clue probably eliminates one of those answers for you, or 2. I see the majority. Majority got it right. It's going to go up to 15% in 2025, or it's set to. But again, that is a ways off. And if there's one thing I can guarantee you is that change happens, and there could be some changes between now and then. So, okay, so given that detailed background on international reform, let's just stop for a second and talk about what really didn't change. And there's only really transfer pricing. So we've been talking about international tax reform thus far. And today's topic is transfer pricing and planning for a lower effective tax rate. So the only thing that changed when it comes to transfer pricing from U.S. tax reform was a slight definition to intangible property. And it really, in my opinion, was done in order to get some of those GILTI and FDII things through, because in the calculation, they have to kind of create a broader kind of definition of intangible property in order to justify the calculations that they came up with. And so that was the only change to transfer pricing. So a lot of people would say, well, I don't really need to do anything or think about anything differently. And it's true when it comes to documentation for transfer pricing, nothing's changed. You can still go about it the way you normally would. But let's talk about planning. Let's talk about effective tax rate planning specifically. I think it's most helpful to talk about where we were prior to January 1st, 2018, so prior to US tax reform taking effect. So we used to have a 35% corporate tax rate, and what we would frequently do for clients, typically who had developed products in the United States, they were either most likely just looking to expand internationally and looking to do so in an intelligent way that was, was tax efficient. And in doing so, we would look at lower tax jurisdictions, or there are companies out there that would just look to lower tax rates and do so in a justifiable way. So what we used to do is look at the functions and risks of the company, see where they were looking to expand in non-US markets, and try to develop a strategy around placing functions and risks into a lower tax jurisdiction. So the place or the country that we frequently talk about, was frequently used most recently, was Ireland, with a 13.5% tax rate. So we used to say, hey, listen, if you're jumping off from the US and you want to sell to Europe or anywhere in the world, really, let's look at possibly having a principal or a holding tech company in Ireland that can justifiably earn some income that would be taxed at a lower tax rate than the US. So we would look at using a country like Ireland to create a principal structure that would take on a lot of the functions. Now, it wouldn't necessarily be Ireland. It would obviously depended on where the business was moving to or where they would be selling. So the Netherlands is obviously geographically very beneficial. It's very easy to get goods into port in the Netherlands and get them to Europe in a broader sense. So we'd often create principal structures and try to, if possible, even do some cost sharing where we have ownership of IP in that jurisdiction. So once that entity would buy in, they would own the economic rights to exploit that IP, and we would have them have those rights to the rest of the world. So they could get income streams based upon that intangible property from the rest of the world. So outside the United States, all coming to that lower tax jurisdiction. So obviously creating a more tax efficient structure. And a lot of times, especially I guess for companies that were already located overseas, they would possibly have pretty decentralized operations. So they wouldn't really have any one kind of principal company or anybody kind of telling them what to do. So these planning operations or outbound planning prior to US tax reform often involved kind of centralizing some of the leadership and strategic functions with that principal company, and then guiding the more limited risk type entities in other tax jurisdictions, which often were higher tax jurisdictions anyway. So we would limit their functions and risks and thus their taxable income in those higher tax jurisdictions. So that was really, in a nutshell, what we would do for tax planning prior to US tax reform. So we're going to walk through a base case, kind of just an example of what we would do, kind of put some numbers behind it. So in this case, we have a US company that developed a product. So they're the IP owner. They did all the R&D, and they did all the manufacturing, whether they did it themselves or by a third party. They were in charge of the manufacturing. And they were exporting products directly to customers in the UK. Please don't anybody yell at me about an IC disc or export incentives, but just in a vacuum, if they're just selling to the UK, if sales to the UK were 100 and it costs $60 to produce those products, leaving us with gross profit of 40, and then their operating expenses, their sales expenses, whatnot, cost 20, leaving us with an operating profit of 20 or taxable income of 20 at a tax rate of 35%, leaves a tax expense of 7. So your effective tax rate is 35%. So is what it is. You're selling to the UK, but was there a more efficient way to do so? And obviously, yes, there was. So step one, let's create a UK distribution company, so related party sales. So in this case, US is selling to the UK, which is then selling to US customers. The US is still in charge of R&D, all IP, and would still manufacture. So in this case, we have the US P&L and UK P&L, and the total P&L doesn't really change here. But if we have UK sales of 100 and, well, actually, let me take a step back. So what we would do is, in order to get the arm's length pricing correct for transfer pricing, and given this is a transfer pricing discussion, is we'd say, hey, listen, what do UK distribution companies typically earn for distribution activities for these types of products? So we'd say, we do a study, say, hey, listen, they typically earn around a 5% operating margin for these type of distribution activities. So we knew what the sales were. So we applied that 5% operating margin. So we get this $5 here based on the 5% operating margin. So we know what that is. Then the UK obviously has sales expense, which is a variable. So we have the 15. So we're moving backwards, backing into what the intercompany price should be here. So we have 15, and we know that we have sales of 100. We know that we have 5% operating profit, and we know we have SG&A of 15. So then, in order to get to that $5 of profit, we need to back into what the cost of the goods would be, which would be 80 in this case. So 80 is the sale from the US. So the US earns 80 on that. It still costs them $60 to produce of their gross profit of 20. They still have some R&D expense, so it's 5, let's say. And they have, so the US now has operating profit of 15, and they have a tax rate of 35%. So the tax expense was 5.3. The UK, obviously, like we said, is earning 5% operating margins. Well, they had a lower tax rate, and it's even lower since. And so they had a 20% rate, so their tax expense was only 1. So our total tax expense drops to 6.3. So we've already dropped from a 35% effective tax rate to 31.3%. So again, this is back in the day when we had a 35% tax rate. To reduce that lower, so I jabbered on about principal companies earlier. So if we took this a step further in planning, again, prior to US tax reform, and we said, hey, listen, the UK is going to license IP from the US to do all the manufacturing and selling. What we come down to is, let's say we insert France as a distributor here. And again, they get that 5% operating margin. And so France has the 5% operating margin. They have their 15 of sales costs. And again, that's the $80 is the intercompany price to the UK. So the UK, that's their sale to France. Again, the UK is licensing, so that's their sales. They're still producing. It costs $50 to produce. They now have a royalty expense of 15 because they have to pay the US a royalty in order to do the manufacturing and to do any of the sales. And so we get to an operating profit in the UK of 15 at 20%. Now the US, they don't have any intercompany sales, but they do have a royalty income here. So this negative is royalty income. They do have R&D expense because they're still doing the R&D. And so the US operating profit drops to 7.5 at 35%. Our tax expense is 2.6. The UK's tax expense is 3 in this case. And in France, a bit higher rate of 33.33%, but they're only a distributor. So they get 1.7 of tax expense. So for a total of 7.3 tax expense. So we've dropped our effective tax rate to 26.5 here. So again, moving those functions to a lower tax jurisdiction, in this case, doing some IP licensing or even selling to a lower tax jurisdiction will pay off in the lower effective tax rate. And so again, this chart just shows, hey, where were we in the beginning where the US was exporting to where we would be if we had a full-fledged kind of principal structure or licensing structure through the UK in this example. All right, fast forward to present day, January 1st, 2018. Go all the way back to our export example here. So now we have an effective tax rate of 21% because, again, that headliner corporate tax rate dropped to 21%. So the US is just selling to the UK, again, sales of 100, same P&L here, except the tax rate's changed. So we have 21%. So then what happens when we think of planning? Well, maybe we think we need to put an entity into the UK. And there are other reasons to have a related party in a foreign country, such as ensuring that your IP is being managed and protected and there's no leakage there. But the point being, let's take a look at that same analysis here, where we do a transfer pricing analysis, say distributors earn 5% or 5% operating margins. We know the SG&A as we back into the cost of goods sold. The US is earning 80 on sales. Again, same P&L, the only change is the tax rates. But look what we have here. The effective tax rates only dropped by 0.2%. So we went from 21% to 20.8%. And you say, hey, well, that's better, right? That's a better effective tax rate. Why not? Well, there's also other expenses, right, involved in setting up a company overseas. So obviously, legal costs, there could be actual physical costs, obviously. So it may not behoove a company to actually create another related party entity. There actually may be some benefit in just exporting those products. So thinking about that going forward. Take that a step further. Again, where we have a licensing scenario, this should look very familiar. Again, the only changes are the effective tax rate in the United States. Because of that reduction, our effective tax rate is actually at 22.7%. And if you think about that, well, we look at France's rate here at 33 1/3, and the UK's rate is only, 1 percentage point less than the US's. It actually has a higher effective tax rate than if we just exported these products here. So the point being, we really need to take a look at how we're approaching selling to countries outside the United States. And really, as we're stating here, there could be less incentive to relocate those functions and risks outside the United States. And again, we're operating in a vacuum here. There are other considerations that we're not plugging into this really simple model here. For example, such as GILTI, there are some high tax exceptions in GILTI where you may want to plan into a higher tax jurisdiction to take advantage of that are not in here. But really the point being, we really need to stop and take a look and do some, what I call phase 1 modeling when it comes to thinking about moving offshore or changing up how your international structure is set up. Really, what I thought was exciting from US tax reform in respect to the corporate tax reduction from 35% to 21% really is inbound planning. So if we have an example here, well, we have an example here where a non-US company, so just think of a foreign parent that owns and develops IP for global markets. Historically, we had the 35% tax rate. So companies coming to the United States would frequently say, hey, listen, what do we need to do for transfer pricing purposes? So it's like, well, okay, you need to do documentation. This is what we do, and this is how you do that. However, they also wanted to know, like, what could they do to kind of reduce their US tax expense? And really, we'd say, hey, listen, the idea is to keep those functions and risks limited in the United States. So try to keep a more routine type of functions here in the US. We'll do a benchmark, we'll figure out what similar companies, the limited risk type companies earn, and let's try to target the lower end of the arm's length range in order to keep that taxable income down at that 35% rate. So we try to minimize the functions and risks and assets and stay at the lower point within that range. So again, that's pre-January 1st, 2018. And what are we talking about here? I like to include this slide. So when we talk about ranges here, we're talking about the interquartile range. So typically in this case, if we're looking at distributors, these are all North American distributors of medical type products, if you will. And what we do is we would identify the companies that are most comparable to our tested parties here, let's say in this case in North America. And we look at what their operating margins would be on a single year basis and on a 3-year weighted average basis. And then we take a interquartile range of those results, and we say, hey, listen, the lower quartile here to the upper quartile, that is the arm's length range. And this is defined in the transfer pricing regulations, section 482 for the US, and in the OECD guidelines or local country transfer pricing regulations really is the interquartile range is the arm's length range. Canada's a one-off where they use the full range for some reason, but really typically we always look at the interquartile range as the arm's length range. So this is what I'm talking about. When we talk about that 5% operating margin, anywhere within this range is considered arm's length. So when I talked about inbound planning pre-US tax reform, we could target this, let's say 2%, 1.9%, 2% operating margin and be considered arm's length because it's within the range. So we would target that to keep our taxable income here in the United States as low as possible. So let's look at that example. So instead of 2%, we have 3% here. So 3% was within that range, compared to that 5%, prior to U.S. tax reform. So in this case, we used the Netherlands as an example, where they have a 25% corporate tax rate. So in this case, the Netherlands is the IP owner. They do all the R&D, develop all the products and manufacture. They sell directly to a U.S. distributor, which then sells to U.S. customers. And so we know the U.S. entity, we'd say, hey, listen, let's stay at the lower end of that range, give them a 3% operating margin. Their sales costs are 15. And we know that what the sales are in the U.S. So we back into this intercompany price to the Netherlands, which is 82. So we have their COGS of 60, their SG&A of 5. So we have their operating profit times their tax rate of 25% gets us to 4.3 of tax expense. The U.S. obviously has a 3% operating margin set here, so they have that times 35% is a 1.1 of tax expense. So we have 5.4 tax expense, which is an effective tax rate of 27%. So obviously a lot less than 35%, and the lower we set the U.S. margins, the better historically. So post U.S. tax reform though, so we have the Netherlands, the same example, we have the Netherlands here at their 25% tax rate, but looky here, we have the U.S. rate is now dropped from 35 to 21%. So what we do in this example is right here, we say U.S. earns a set 6% operating margin. Guess what? Both those 3% and 6%, they're both within that interquartile or arm's length range. So any point within that range, again, is considered arm's length. So we say, hey, listen, nothing's changed here. None of the functions and risks have changed. Nothing with the business has changed. But hey, we're within the range, so we're going to set the U.S. operating margin at 6. So again, SG and sales costs are the same, but looked at the intercompany price, it's dropped to 79. So again, the Netherlands earns 79. We dropped through their P&L here. They get operating profit has dropped to 14 at 25% is a 3.5, $3.50 of tax expense in the Netherlands. Look at what the U.S. has dropped to, 1.2, for a total tax expense here of 4.7. And look at that effective tax rate. It's dropped from 27 to 23.5. So merely by moving around within that arm's length range, we were able to save, save like 3.5% on our effective tax rate. So again, that shows, this is just to kind of summarize that. So that was a simple example where nothing changed with the business. None of the functions and risks changed. We were just able to move within that intercompany range. But let's take that a step further. What if we were to increase the functions or increase what's being done here in the United States? Let's say we move some development to the United States and we actually use the United States as a jumping off point for sales and sales into maybe, let's say, other parts of North America. And we add some functions here. So we can justify, in that example, we can justify even more profit being allocated or coming in at that 21% rate in this case compared to the Netherlands rate of 25%. And I just picked on the Netherlands here. I know their rate's dropping. But there are other countries out there, obviously, with higher tax rates now than our 21%. The other thing to consider is going back to our FDII. Any payments for IP to a U.S. company will qualify for that rate. And we haven't shown that here. So there's a couple of things that's going on there. I mentioned, sales to other countries. So if you start exporting from the U.S., once you have certain, functions and risks here, you can qualify for that 13 and 8%. So there could be some incentive to shift some things into the United States, which I know sounds like the antithesis to everything that we used to kind of preach for effective tax rate planning prior to US tax reform, and it is really. But there is some incentive there, and really to the extent that you already have operations in the United States, you may be saving money. You may think, hey, maybe we don't need to move some things offshore or create other entities. Maybe we should just enhance what we're doing here in the US and think about exporting. So, and again, from an inbound example, maybe companies do want to invest more in the United States, and kind of go from there. So, so really to wrap things up, here's some key questions to think about. But really, let's take a step back again, because what I didn't, I talked about, I gave a little transfer pricing again, kind of overview at the beginning. Really, one of the things that I didn't cover, and I talk about here quite a bit, is kind of functions, risks, and assets. And what we do when we do a transfer pricing study and looking at, kind of who's doing what and where, is we do a functional analysis. And so what we do is we talk to as many people as as makes sense to kind of figure out, in a nutshell, who is doing what and where. Because logic would follow that the entity that's taking on more complex and more functions and is bearing more risks should earn higher profitability. So if you're an investor, you're higher your risk, you're going to expect a higher rate of return on that. So following that logic, we would expect the entities that are doing more, taking more risks, making more decisions, doing more non-routine functions to earn the higher level of profitability. So what we need to do, and it's become, I think, increasingly more important, and it really goes back to the origins of transfer pricing, which leads me to the phrase, everything old is new again, is we really do need to do our due diligence on a functional analysis. We need to go in and really examine who's doing what and where, who really is doing, taking charge of the development, who owns that IP, and who is really, what is the real true value driver? We often hear, lately it's a popular catchphrase when it comes to transfer pricing is something called a value chain analysis. And really what that is speaking to is what is driving the true value for our product and our companies? Where is the true value being driven? Is it really these routine type functions, these kind of general things that are just kind of going on with an entity, or is it really a thought process? Is it potentially an efficiency process? Is it something else that's really driving the value for our products? And really, you really need to do a really legit and deep dive functional analysis in order to kind of determine who's doing that and lay that out. The other thing you hear a lot about along with value chain analysis is this word fairness. And it's an interesting word to me. I don't really like to use it. I don't think it's appropriate, but you'll hear, specifically outside the United States, well, what's the fair amount of taxable income? Well, the fair amount of taxable income is whatever is due to the company based upon what they're doing. So again, it goes back to a functional analysis. So fairness is a weird term because it's really fairness based upon who's doing what, who's again doing those functions, and who's bearing the vast majority of the risks. So what we like to look at here when we talk to companies that are maybe thinking about either jumping offshore or coming onshore, or they're already, they have international operations, but they're thinking about changing things up or expanding them, is what's the future of this company, and what's really the value driver? Because we want to look at, hey, where should those intangible assets be located? Maybe it makes sense to bring more into the United States, develop more in the U.S. to take advantage of some of those benefits that we have with FDII. But where's the company going? Like, where do you see the company going in the future? And one of the things we need to consider, is often asked, is what's the future in terms of an exit plan? Does this company, are we going to continue to exist for a long time? Is it going to be sold in the near future? Because those are some considerations as well when considering whether to actually create foreign entities. So how's your business evolving, in the coming 5 to 10 years, and realistically evolving, right? Because projections can always be rosy, but let's take a realistic look at where do we think this company is headed, and really where might you benefit outside the United States in terms of selling your products or expanding your products. Are you becoming more global already, or would it have you maxed out domestically, and can you actually benefit from expanding globally? And maybe we start with some type of export and take advantage of those incentives, but then we think, hey, maybe it would make sense to create a structure where you have entities in the local countries in order to expand in those countries, in order to protect your IP, in order to further develop those markets. And speaking, like which markets, both product-wise and around the world, do you think you're going to enter? So it really does behoove us to kind of take a look and see what the future plans of the companies are, what the owners plan to do. Do they plan to stay in this business for a while and expand, and where do they see the business going? The other thing that I think a lot of people don't think about when planning for transfer pricing, and this is regardless of US tax reform, is really the functions and from an operational perspective. So there are businesses that really thrive being decentralized and kind of creating their own balance intercompany-wise, because entities can purchase from one another or interact with one another. They have multiple choices, and they really do exist and thrive that way. But oftentimes, it does help or assist companies in centralizing activities. And when doing so, a transfer pricing analysis can be extremely helpful, because again, we do that functional analysis. We come in and say, hey, listen, guys, you guys are doing this activity here. Did you realize this? And oh, by the way, the value is being driven here. Did you realize that? Might you benefit from possibly managing that and guiding that and taking more more routine functions and putting them in certain places that really are just kind of really their core competency is just completing those routine functions, and let's put those there and have a lower tax burden in that country, versus, hey, let's centralize some activities in maybe a lower tax jurisdiction and really have it more centralized and more strategy. But there are definite business advantages to doing so as well. It's not just a tax play or a transfer pricing play, but I've been on numerous functional interviews with company personnel asking questions, and the thing I hear quite often is, wow, I never realized that's what we do specifically, and that's where we actually do it. So there could be other non-tax reasons for centralizing or moving certain functions around. But obviously when doing this, there's a tax efficient way of doing it. And given US tax reform, we want to think through all the aspects now. The US has come into play, so we definitely want to model that out as well and kind of create an additional, phase one, you can't get any lower than 1. So your phase 1 analysis now becomes more complex, and we say, hey, listen, the US is a player here too. Let's consider leaving functions or moving more functions to the United States because of our lower corporate rate and our incentives and our disincentives given US tax reform. So I think that ends, so we have time for questions. I don't see any questions coming into our session here. Feel free to type any in. We'll try to get them answered. We certainly have time now to answer those. If not, I'll pause for a minute here and let you ask any questions, excuse me. But if not, I just want to thank you for attending and listening to our webinar here. I hope you gained some ideas around planning for transfer pricing, how it's not just a documentation or a compliance exercise. There's actual strategic planning that can be done to lower your effective tax rate using transfer pricing. All right, thanks everybody.
Thank you.